Well, holy smokes, everyone. What an absolute wild couple of days it has been in the markets. But I know what you may be thinking, well, what exactly is causing this massive chaos and uncertainty in the markets right now? Well, everyone, what if I told you that there was a $20 trillion trade created 3 decades ago that is about to unwind? And if it fully unwinds, experts are warning this could cause a global financial crisis far worse than 2008. So what exactly is this trade called? Well, that's called the Japanese yen carry trade. Now, I know you may have heard of this before, and many YouTubers are saying, just very quickly, oh, the reason why the market is down is because of Japanese yen carry trade. But many people have no idea what is the Japanese yen carry trade. And I haven't seen many YouTubers been able to put out a video to explain exactly what is this? Why did this get created 30 years ago? Why are all our 401ks, superannuation, retirement funds in this trade? How exactly does it work? And really what we need to know, because it's just starting right now, what are the consequences if this trade fully unwinds? Well, everyone, you don't need to wonder any longer, because I'm going to break it down in this video, because we've got recent news. There's been recent financial events happening in the financial system right now to say it is actually unwinding right before our eyes. And this is why we're seeing such huge volatility. And of course, everyone, I'm going to break this down in very, very simple terms, because these financial institutions that have your 401k, your superannuation, your retirement funds, they want you to think that this is too complicated for you to understand, so that way you don't understand what they're really doing with your money. So everyone, you know what time it is. Let's get straight into the news, the facts, and the data. Well, okay, everybody, first things first is this, everyone. And like I said, I think it has already actually begun. Japan's yield shock threatened global markets, and Bitcoin may be next. Now, while they're talking about Bitcoin in this article, we've seen this with stocks. We saw Nvidia had a massive swing yesterday where it was up 5% and then tanked 3%. There was a short-term bounce today in the markets, but that's just short-term noise. We have to look at the bigger picture that is happening. And yesterday we saw Bitcoin absolutely tank all the way down to 81,000. And this is why I've been warning people about that. Yes, while I'm a long-term believer in Bitcoin, we are actually in a Bitcoin bear market right now. So it says here, Japan's government bond yields have jumped to record highs, and the spike comes after the government revealed it was $110 billion stimulus package plan, challenging traditional economic expectations. So this is the first part of the story, Japanese bond yields, and this is how this carry trade began. Because in the 1990s, after Japan's stock market crashed and its economy entered a severe recession, it dropped its interest rates all the way to zero, when many other central banks or many other economies had interest rates of 5, 6, or 7%. So before I dive deeper into the story, let's explain exactly what this Japanese yen carry trade is. Think of it like taking out a mortgage for 0% interest. For 30 years, the Bank of Japan has kept its official interest rate near zero, essentially making the Japanese yen the cheapest currency in the world to borrow money. So smart investors like hedge funds come in and say, great, I'll borrow $1 billion yen for almost nothing. And they immediately sell that cheap yen and convert it into currency that pays high interest, like the US dollar. They then take those US dollars and buy high yielding assets like US Treasury bonds paying 5%, or Australian corporate debt, or European stocks that are paying well more than the 0.5% to earn a 5% on their investment. And they profit the difference, an easy 4.5 to 5% return. Now, this sounds pretty easy, but why does this matter so much for the markets? Well, it's because this isn't a small trade. We're talking about an estimated 3 to 7 trillion worth of global borrowing, and where does all that yen borrowed money go? Well, a huge amount of it goes directly into the US markets. The yen carry trade is what funds trillions in US investments. It's a silent buyer of US stocks and a major financer of the US government debt, your treasury bonds. And who is the biggest holder of US treasuries? Well, that is Japan. They hold 1.1 trillion of US treasuries. So here's the thing, the US markets are standing on a foundation partly built with incredibly cheap Japanese debt. As long as the debt is cheap, the money stays in the US and the markets are liquid. That is until the unwind happens. And this is why I'm making this video and it's so urgent, because I believe the unwind is happening right now. But again, what are the consequences for this unwind, and what could the worst possible scenario be? Well, the entire trade collapses the moment the Bank of Japan decides to lift interest rates, and that's what we're seeing right now. I'll go ahead and pull up some Japanese government bonds. We can see here the 10-year has gone from negative 15 basis points to 1.7%. We can see the 40-year has gone from 0 all the way to 3.7%. So investors are starting to see that the difference between Japanese yields and the US is no longer profitable now with all the fees when they're trading currencies, and they're now starting to sell these loans. Now here's the big risk. They made the loan when the yen was weak. Now everyone is rushing to buy yen back to repay their loan, which instantly makes the yen stronger or more expensive. Again, this is the worst case scenario. So if the yen strengthens, say 20 or 30%, well, now all of a sudden they need 20 or 30% more US dollars to pay back that loan denominated in the Japanese yen. If they don't have their US dollars, well, what do they have to do? Sell everything. They'll have to liquidate their stock portfolio, their US bonds, and their riskier assets, normally like what they see first, like Bitcoin, and this is what this article is going on about, or they may even have to be forced to sell other assets as well. So what does selling all these assets trigger? Well, the simultaneous forced liquidation of trillions of dollars caused two things. First, a flash crash across global markets as supply overwhelms demand, and this is what we saw happen on Thursday with a massive swing with Nvidia stock and many other high-flying tech stocks and Bitcoin. Second, massive liquidity drain as trillions of dollars are pulled out of the system and put back into the yen. So now that you know what the Japanese yen carry trade is and the severe consequences if it unwinds, let's now dive back into this article to show the unwind has already begun. So again, Japan yield shock threatens global markets. So let's dive a bit deeper. Well, it says this dramatic development signals a shift in global finance, putting pressure on an estimated 20 trillion carry trade. Moreover, it could have significant implications for cryptocurrencies, including Bitcoin. But people, this is going to be all assets, US treasuries, stocks, especially high-flying tech stocks, and all of us are invested in this trade because of the 401ks, the superannuation, whether you like it or not. Because like I was talking about, Japan's historic yield surge upends market logic. Japan's bond market surprised investors this week as the 40 yield soared to 3.69%, the highest since the securities launched in 2007. So like I was saying before, the trade is starting to no longer make sense for many of these investors. The risk is simply too great. They describe the moves as a vote of no confidence in Japan's sovereign debt sustainability. The country's debt load stands at approximately, look at this, if you think that the US debt to GDP or the debt crisis can't get worse, look at how bad Japan is. Approximately 250% of its GDP, and interest payments already account for 23% of annual tax revenue. That's right, nearly a quarter of all their income is going just to service the interest. Now, look at this. This is the 5 countries with the highest GDP. We see countries like Lebanon and Sudan, obviously the highest, but they're very small economies. Japan is the highest out of all the major economies, just behind Singapore, and it's not even close. Look, Singapore is 168% compared to Japan's 255%. And the reason why we have to watch this is because Japan is the 4th biggest economy in the world here, with a GDP of 4.2 trillion, almost overtaking Germany of 4.5 trillion. And so this has been the biggest financer of the US government debt, and this trade is about to unwind like I was just saying. Now, analysts estimate that every 100 basis point increase in yields add more than 2.8 trillion yen to the government's yearly financing burden. The math stops working above 4%, and the market just priced in that threshold is approaching. Now, like I explained to you before, the implications extend far beyond Japan. Rising long-term yields threaten the foundation of the long-standing yen carry trade, in which global investors borrow at low rates in the yen and deploy capital into high-yielding markets abroad. The largest arbitrage trade in human history, built on Japanese rates staying frozen forever, that assumption died yesterday, he said, and I completely agree. Now, they've done some more studies on the correlation between this trade and the S&P 500. So correlation studies show a 0.55 relationship between the yen carry trade unwinding and the S&P 500 drops. Emerging market currencies fall 1 to 3% within 30 days. US Treasury yields climb 15 to 40 basis points from reduced Japanese demand. So this is why we're seeing, even though the Federal Reserve is cutting rates, the 10-year US Treasury yield is staying stubbornly high around 4% because the buyers are leaving. Your 401k holds positions funded by yen loans, your tech stocks trade at valuations, assuming cheap leverage continues, and your emerging market bonds depend on foreign capital that's now leaving. Investors may start trimming their foreign positions and moving capital back into Japan, which removes support from risk-oriented markets worldwide. If this pattern continues, it could trigger a broad selling of international assets, most notably US Treasuries and equity ETFs. So people, are you starting to get the picture here that things are very, very bad? And we also got news that things got even worse for Japan that is going to escalate this scenario. Well, look at this. This is what I covered a few days ago, and this was a warning sign. SoftBank, which is a major firm in Japan, sold their entire stake in Nvidia for $5.8 billion. Now, this was on the 11th of November before this massive sell-off in Nvidia stock, which caused the whole S&P 500 and the NASDAQ to go down. Now, for those of you that don't know who SoftBank is, this is the man, the CEO of SoftBank, that announced they're going to have $100 billion invested in US projects in the AI boom. But now they're starting to face some very, very big issues now that a lot of investors are losing faith in these AI companies being able to deliver, and they're saying, look, their valuations are simply too high. And so what did this cause? Well, yesterday it caused SoftBank to plunge over 10% as Asia markets track Wall Street's stunning reversal in AI stocks. And it just got even worse for Japan's central bank because core inflation just rose at its fastest rate, and this is meaning there's going to be more interest rate hikes. So look at this, Japan's core inflation in October rose at its fastest rate since July, in line with markets' estimates on Friday, supporting the case for interest rate hikes by the Bank of Japan. So Japan is being hit from multiple angles, which is going to accelerate this unwind in the Japanese yen carry trade. We're seeing inflation rise, interest rate rises. We're seeing companies that lent huge amounts of money to US firms on the AI boom, which is now not being able to deliver on the revenue it promised. But there's also another story I don't see many financial analysts covering because they focus just on the financials. We also need to look at the geopolitical picture, and that is China. And China is absolutely furious at the Japanese new prime minister after her comments on Taiwan. Now, again, we won't get into the deep political issues here. We're going to stick to the financials, but this is going to have huge financial implications for the Japanese economy. So look at this, everyone. China's fury at Japan reminds the region of its ultimate red line. So what is China's ultimate red line? Well, that is making comments on Taiwan. China believes that Taiwan belongs to China and that it need to be reunified with China. Especially this would be a big, huge geopolitical strategic win for China because of all the chips that Taiwan is creating. But Japan's Prime Minister came out and said, look, if you invade Taiwan, we will have military action to protect Taiwan. And of course, this made China furious, and they're now going to have severe economic sanctions put on Japan, which is going to make the economic situation and their government deficit even worse. Because look at this, Japanese concerts in China are getting abruptly cancelled as tensions simmer. So Japan has increased its pushback against Japanese Prime Minister with its Taiwan comments. Concerts with Japanese artists in Beijing have been cancelled or postponed, sometimes with little notice. It says you don't have predictability because nobody announces the policies publicly, an agent who organised more than 70 concerts in China over the last 12 months. So everyone, I know that's a lot of information. So what does all these moving parts mean in simple terms? Well, what this simply means is the financier for all this debt, this boom over the past 30 years has been Japan. Investors, hedge funds, superannuation, retirement funds have been able to borrow money from Japan at 0% interest and then invest the difference in the US or other emerging markets, but that simply isn't the case anymore. Inflation is now surging instead of deflation in Japan, interest rates are rising, and the trade no longer makes sense. What this is going to lead to is a lot of these hedge funds and these retirement funds that have these loans, they're going to now need more US dollars to pay back the Japanese yen if the Japanese yen keeps on going up, and they're going to have to simply sell assets like US treasuries and stocks to do this. And if the situation gets worse, well, we're going to see yields in the US treasury spike. If yields spike in bonds, why invest in risky AI stocks when you can get a guaranteed return of 6 or 7% in US treasuries? Again, this is the worst case scenario. Well, simply people won't. And this would cause a huge stock market crash. Again, I'm not saying this is guaranteed to happen. I'm saying this is a scenario if things continue to deteriorate like what's already happening. But everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.